So folks, let's talk about continuation patterns further and let's discuss a flag and a pole pattern. As the name suggests, this pattern is very similar to a flag and a pole. A typical characteristic of this pattern is formed when the stock is in a quick move and then it consolidates for a bit. The move can be on the upside, which is an indication of a bullish flag and a pole pattern, or the move can be on a downside, which is indication of a bearish flag and pole pattern. And once the pattern is complete, it is expected that the same trend will continue to follow, which means if it is a bullish flag and a pole pattern where the stock is in an uptrend forming the pole, consolidation forming the flag, it is expected that the stock will continue the uptrend after the consolidation is over. Likewise, if the stock is in a bear grip and is coming down, it will consolidate for a bit forming the flag and continue the down movement. And hence these are known as continuation patterns. So let's look at these with an example. So as you can see on my screen, I have the chart of Nifty 50 index on a weekly time frame, and if you notice, in this particular time period, Nifty gave a very strong up move and followed by a consolidation. This particular up move can be regarded as the pole, and this consolidation or correction can be regarded as a flag. And once the flag pattern is complete, if you notice this candle, this is a long body Marubozu candle, and this is also a significant candle in terms of the breakout from the flag and pole pattern. So as you can see, the stock or the index was in an upward journey, it consolidated for a bit and then it again resumed back its up journey. So this is known as a bullish flag pattern or a bullish flag and pole pattern, and it's a continuation pattern indicating that the up run will continue after the consolidation phase is over. Conversely, if you look at the other example where I have the chart of Graphite India on a weekly time frame, the stock came down drastically forming the pole and then it consolidated for a bit, and once the consolidation was over, it again resumed its downward journey. So this is the example of a bearish flag and pole pattern or a bearish flag pattern where the stock was in a downtrend, it consolidated for a bit and then it again resumed its downward journey. So folks, to summarize, we have covered the various types of chart patterns in this video series. The first one being a reversal pattern, the second one being a continuation pattern. And for each of these categories, we have a bullish and a bearish category. For example, for reversal patterns, we may have a bullish reversal pattern or a bearish reversal pattern. And similarly, for continuation patterns, we may have a bullish continuation pattern like the flag and a pole pattern and a bearish continuation pattern like an inverted flag and pole pattern. And to summarize the key points that we have considered, never look at patterns in isolation. Always and always try to use EMAs to your advantage when you are identifying patterns, because EMAs will give you a very strong signal about the overall market sentiment, because it is the smoothened average of the price over a defined look back period. So never use chart patterns in isolation, always use EMAs along with your candlestick charts. Second, whenever your chart pattern is nearing completion, always watch out for the candle at the breakout zone or the breakdown zone, because the candle conveys a lot of meaning in terms of the market sentiment and psychology. Third, you can use various oscillators like RSI or MACD to your advantage to attest your view of the pattern formation. Fourth, patterns take time to develop. So never rush into taking a trade just because you are seeing a pattern in formation. You wait for the trade to be ripe and mature, and it's only then you define your entry, exit and targets. And finally, patterns like technical analysis can be applied to charts at any given time frame. It can even be applied to a 5-minute period chart or a 1-month period chart. But do remember, patterns when formed on a higher time frame chart hold more significance and has more value when compared to a pattern in a lower time frame chart. So with these learnings in mind and with the examples that we have covered with the various rules, around chart patterns in conjunction with EMAs, practice as much as you can and try to look for similar formations on a given chart in the prior periods and see what the outcome looked like. If you notice that in the prior periods a particular pattern has been formed multiple times and the outcome was in line with the expectation of the pattern formation, then the probability that in this particular instance also the pattern will behave in line with our expectations, the probability will rise and you will have a very successful trade. And you will have a successful trade, which means you will be able to meet your targets and not hit your stop losses. However, if you do rush into taking trades and take trades when the pattern formation is not complete, there is a possibility that the pattern fails and the pattern does not complete and you end up hitting your stop losses. So I hope this series on chart patterns was informative and you are able to make more sense of the various terminologies that people use in the context of chart patterns. Practice as much as you can and I wish you all the best. Thank you.